Welcome everyone to the April edition of our monthly strategy update, which happens to be the end of the first quarter, if you can believe it, and on the heels of tariffs that'll be taking place soon. So thank you for taking your time out of your day to join us. My name is Keith Duran. I'm the Senior VP of Business Development, and I'm joined as always by Jim Warner, Head of Research and Co-Portfolio Manager. Before we begin, for any of the new folks who've joined us for the first time, these brief webinars are not only to provide a backdrop to the markets and economy, but also how we relate that data to our portfolios and the themes that we invest in. In other words, how does a truly dynamic manager manage risk, particularly given, the recent volatility? So if you understand the long-term irrefutable themes combined with, economic activity, you and your clients can easily understand the rationale for holding a particular security in the portfolio, which is also very simple to understand, given that we only have a maximum of 30 positions. So before I hand it over to Jim, we encourage questions. So feel free to use the Q&A button at the bottom of the screen as we move through the presentation, and then we'll address those at the end of Jim's prepared remarks. And so therefore, without delay, Jim.
Great. Thanks, Keith. Appreciate it. Thanks to everybody who's joining us today. As Keith said, if you've got questions, we've got this little bar at the bottom that for Q&A, and I love to get questions. It helps me know that that what I'm trying to convey is getting through. So this month, what we're talking about here is the lack of clarity coming to an end. And so if you're an avid watcher of CNBC or any of those programs, the big conversation has been about uncertainty and a lack of clarity on a variety of topics, and we're going to get into each one. And Keith already alluded to one, which is tariffs. So if we look at the CNN fear and greed meter, we're still pinned at extreme fear. This is the same place we were a month ago when I showed you this. So what's going on? Well, basically, there are three key negative market narratives that are dominating sentiment right now and causing very, very negative sentiment. The first one, as you know, is AI. So these are the biggest underperformers this year in the market, by and large. And essentially, the worry is that the CapEx for data centers may peak in 2025. As you know, the big hyperscalers are spending billions and billions, tens of billions of dollars. And so the worry is that that's going to peak. And but the strange part about that is that the earnings associated with those build outs, and of course the companies that will build applications on top of that, hasn't even barely started. And so, but nevertheless, this was a very crowded trade that is now unwound considerably. The sentiment is now very poor on these stocks. We actually think there's a lot of value in them, and because we're still at the very early innings of this whole wave. So as Keith mentioned, we like secular themes, and we've been a fan of AI as a secular theme for quite some time now, several years. We still think it's a great secular theme. And so the other interesting part of this decline that we've seen is that it's all valuation driven. It's basically a compression in PE. It is not it's not really a revision downward in earnings estimates. And so we'll go through a little bit of that and where we are today. But needless to say, we are about 2-3 weeks away from the next earnings season. And so it's going to be a very important catalyst, particularly for AI stocks. If we don't see guidance changed or revised downward, I think you're going to see a really big rally. So that's one negative that's been dominating the market. The other one is DOGE. And what is the impact going to be of the sweeping review of federal agencies with the intention of eliminating wasteful spending, but it's impacted a number of other sectors such as defense, consulting, and then sort of related to DOGE, but this is really more of an RFK HHS issue. But what other kinds of reforms, governmental reforms will occur that might impact biotech or pharmaceutical or food groups, food manufacturers. But needless to say, that's weighed on certain names. And as we discussed about a month ago, we started buying a company called CACI, which is a defense IT services contractor. we've known this company for 15 years, and there's very, very little, an immaterial amount of what we think of is revenues exposed to any potential Doge cuts. So it's been a great opportunity to buy a great company at a really, really great valuation. And then the last thing, of course, is tariffs, as Keith mentioned. And last week we got the auto tariffs, and I have to tell you, they are quite scary. We've gone through and done a bunch of analysis. I'm not going to go through all the details of the auto tariffs. I wrote a paper, research paper, last week that if you haven't read it, you should. If you need it, contact Keith or me, and we'll get it to you. But basically, it goes through what the tariffs mean. But essentially, it's a 25% tax on in fully assembled imports, and also on critical parts like engines, powertrains, and transmissions. And the problem here, honestly, is that it actually makes, in particular, Ford and GM unprofitable. If you look at sort of what we think are going to be the earnings impact of these tariffs, it actually wipes out profitability of GM and Ford, which, by the way, will put them in jeopardy of breaching debt covenants. And I don't think, and that, of course, would lead any CFO to probably laying off U.S. workers, which is the exact opposite intent that the Trump administration is trying to obtain. So I think there's going to be some changes to this particular thing. And I think that's really kind of what we've also learned about President Trump. He will put out, kind of an extreme proposal, and then will back off it and claim victory. And I think that this is one of those situations. Now, this afternoon at 3 p.m. Central, 4 p.m. Eastern, President Trump will announce another more wide-ranging set of tariffs, essentially on the globe. And there's not a lot known exactly about what he is going to say. So there's a lot of uncertainty around that. Some suggest that it could be a 20% broad across the board tariff, and that's effectively what's priced into the market today. It also could be just targeted on specific companies or even specific goods. We don't know. And so because we don't know, we don't really know what the impact is going to be on the economy or inflation. But what the issue is going to be, obviously, on a product-to-product basis. Is there a substitutional, a product you can substitute for? And so it's extremely difficult to know whether this is inflationary at all or by how much. And we don't know what kind of damage this could do to the economy. And what I'm thinking, and when I say that, is layoffs. When companies are less profitable, they have to lay off workers. So it's going to take some time to understand this. And again, this could change. This could evolve. And so it's creating uncertainty. And so will we get clarity, on the AI thing? Yes. And I think we'll get some clarity on that in 1Q. We're going to continually get more clarity on Doge. But the tariff issue is going to be one where we're going to have to live with some uncertainty, I think, for a good while. Now, a lot is already negative is priced into the market because the market hates uncertainty. And so any sort of additional clarity, which today actually might provide, could actually be the basis for a market rally. So it's really about what's priced in, and there's a lot of negativity. This was honestly we always talk about, there's like a 2/3 probability that every year you get a 10% correction for whatever reason. We got one. We got a big one in the NASDAQ. The NASDAQ's off 14% from its high. The NASDAQ's off 9%. It was down over 10% at one point a week or two ago. This was actually one of the fastest 10% corrections we've ever experienced without some sort of like existential crisis like 9/11 or the global financial crisis. This was a really pretty aggressive correction. And it was entirely driven really about negative and this whole cloud of uncertainty that looms over the market that we just talked about. Interestingly though, the S&P and the NASDAQ are both sitting on some pretty critical support levels if you're a technical analyst. I just drew a little line between connecting all the lows in the S&P 500, and you see sort of like we bounced off it and then we tested it. And then we rallied a little yesterday. We're going to rally a little bit today. Who knows? But that could be a good basis for a rally from here. NASDAQ similarly is sort of challenging this most recent low. And as of yesterday and today, is kind of getting a little bit of a bounce. So, time will tell. It's, important to kind of stay ready to deploy risk assets. And I'll get into portfolio positioning in a minute. So what's also going on? What's going on? So I mentioned negative sentiment. It's actually incredibly negative. If we dig into the University of Michigan Consumer Expectations Index, this actually is really interesting. The bar chart on the left shows you that we've declined back to levels that we really haven't seen since like inflation was a really big problem back in 2023. But these are still, regardless, a very, kind of a very steep fade in expectations. If you split it out by political party, that's one of the interesting things about this particular survey is they actually asked the respondents what political party do you identify with. You can see that the red line is the Republicans that responded to this poll, and they basically were kind of down on the dumps until the election. Then you saw a spike, and now they're basically sitting around, kind of near 100. Typically, this index never goes really any higher than about 120 would be like complete euphoria. So, the Republicans are obviously happy with the election results, and while there's been a little fade in that sentiment, they're still above the historical average, which goes back to 1980 of 77. So Republicans, by and large, are pretty optimistic. Democrats are downright depressed. They are currently at the lowest levels ever recorded. So in 45 years, this survey has been going on. There's never been a moment where Democrats have been this, pessimistic. So the one reason why I bring this up is twofold. Number one is if you're listening to, the media, you have to understand who you're listening to and what their political persuasion is, because it's very easy for people to sort of bias their words, their word choice, or their phraseology based on their political persuasion. And so if you're listening to sort of a left or more leaning media outlet, you're more likely going to hear more pessimistic news than you are, like say if you're watching like Fox News, which leans obviously very right. So keep that in mind. The other thing that is really important, and this may be way more important, is that to be a good investor, you must be apolitical. You must accept the data, analyze the data, look for more data. If it agrees with you, look for more data that doesn't agree with you. But don't ever let politics persuade you one way or the other in terms of making a choice. And that's what we have always strived to do here at Lear. All right, so I've updated this chart from last month. It continues to be that last year's leaders are this year's relative losers. The Magnificent Seven's down 16% year to date, while the rest of the S&P is basically flat to up a little. That's pretty remarkable, right? Again, put this in the context of uncertainty and now that sort of thing about even the economy. We're talking about the tech stocks being the ones that are underperforming. The growth stocks, for example, are down 10%. The value stocks are up to, what you're seeing here is a very interesting confluence where you have uncertainty that tends to be surrounding the economy, and yet the biggest underperformers really have the least sensitivity to the economy. And I think that's an important point that that I'll touch on in a little bit. So where are we now in terms of valuations, right? So a few months ago, we were talking about valuations were stretched. That's not the case anymore. What I've done here is I've plotted the PEs, the forward-looking PEs, next 12 months for the Magnificent Seven, which is the lighter blue line at the top, and the rest of the S&P 500, the other 493 names. And what you can see is that the Magnificent Seven is now trading at around 25 times, which is a discount to its 5-year average of 30. So what that means is that because estimates haven't changed yet, when you see a compression in PEs like this, it means that the investors in the market believe that earnings estimates have to come down. So this is the reason why I mentioned earlier why 1Q earnings is so important, in particular for Mag 7 names. If they can simply maintain their guidance and keep estimates where they are, that's going to be actually very positive, and we could get a rally on that. Now, if we look at the rest of the S&P 500, you can see that they are basically trading about with their 5-year average of around 19 times. So We're not really overvalued. We actually never really were overvalued in all the rest of the S&P. It was really just these Mag 7 names that got a touch overvalued and now are actually relatively undervalued. So if we look at sector performance, it's really, as I just mentioned, it's really not reflective of a growth scare. If we look at just this table here, what's been performing well this year? Leading it off is energy. Well, it's hard to get any more cyclical than an energy company. Financials are up 3.1%. Materials are up 2.3%. Industrials are basically flat. I mean, though all of those very cyclical sectors are outperforming the broader index. And so so what's happening is investors aren't, freaking out and selling cyclicals. In fact, they're just selling tech and they're moving into everything else. That's essentially what's happening. And of course, like defensive names like healthcare and staples, they're obviously going to attract the crew of folks that are worried about the economy. But the only places that are really getting hit are, you can see the telecom services and information technology, those are your tech companies, and consumer discretionary, which actually a big part of that is Amazon. Tesla's in there too. So you have some Mag 7 exposure, but you also have companies that are going to be directly impacted by tariffs. And so there's, what this is telling is that the market, like us, has been really avoiding exposure to the obvious places where tariffs are going to have an impact. So let's do a quick economic check. So I showed this chart last month, and I'm going to show it until it changes. But it's actually starting to change a little bit. The Citi Economic Surprise Index, what this measures is when the actual economic macro data like payrolls, inflation, spending, et cetera, when it comes in better than expected, this line goes up. So it means that basically the forecasters on Wall Street basically underestimated how good the data was. So when it goes down, it means that the forecasters overestimated, and then the data actually came in weaker than expected. And so you see that essentially since the beginning of the year, really in December, essentially the forecasters on Wall Street were kind of over optimistic. And usually what happens is that eventually the market kind of follows this index. And we've now maybe bottomed where actually the forecasters have gotten too pessimistic and the data is actually starting to come in a little bit better than expected. And so this is maybe another reason why we could see a rally off these bottoms, because you're starting to see the sentiment change and the data coming in better than feared. I think that's always the first step in getting a recovery in markets, is things come in better than feared. Now, I don't think this is a really important slide, but I only show it because you're probably going to get a question about it from your clients. The Atlanta Fed GDP model has raised some eyebrows recently because it's estimating that the first quarter GDP growth is going to be pretty negative. I think there might have been an update this morning, but basically it's still showing that the economy in 1Q contracted. So now, before you get worried about if this is a recession, there's two weird things going on that is actually mathematically creating it. So if you think back to your macroeconomics 101 class, GDP is impacted by imports, and when imports surge, the calculation declines. So basically, what you're seeing is there's been this weird phenomenon where banks and other institutions in the United States have been pulling gold bars back to the United States. So there's been this big surge in gold. I talked a little bit about this last week. The other thing that's going on, it's really evident in manufacturing numbers, is that in anticipation of these tariffs, which again are no surprise, everybody knew these were coming. I mean, President Trump put them on before, and he talked about it in his campaign trail. And so what you saw was basically the last few months since the election, this massive pull forward of inventory and supplies from overseas. And so those two things combined has created this massive surge in imports, which is not going to remain. As soon as these tariffs go up, you're going to see that number come crashing down. What does it actually matter to the actual GDP and the economy? Not a lot. Now, the implications of tariffs obviously could have a very material effect, but in terms of consumption, or which is really the biggest driver of GDP, really mathematically doesn't have a whole lot of impact on it. So kind of where are we today? Well, the labor market is still solid, but we know government layoffs are coming. And you can even see, uh, but if you take a step back though, where are we in the economy from a labor market perspective? It's still very strong. The unemployment rate, for example, the graph on the left, we're still hovering around 4.1%, which is basically where we've been for well over a year now. But we're always looking ahead and looking forward to what, for deterioration. And so far, really, the only deterioration we're seeing is in the federal government layoffs, compliments of Doge. We've seen a little bit of a tick up here, which is captures some of it. There's going to be more coming. I honestly think that the market will look through these layoffs. The real question is going to be, do we see layoffs in the rest of the economy? And again, tariffs could have an impact on that. It's just something we're going to have to wait and watch. So, but from a demand standpoint, frankly, the demand for labor is still very good. If you look at the JOLTS job openings survey on the left, you'll notice that we're actually above the red line. The red line is the pre-pandemic number. So we've basically been normalizing back to pre-pandemic levels. And if anybody can recall, 2019 was actually a really good year for the labor market. The unemployment rate was only 3.5%. And so we still have more job openings than even then. So that's a good sign. This could all change very dramatically, but it's a good sign. The other really good sign is if you look inside the PMI numbers for the services sector, there's actually been an acceleration in hiring plans. So this chart on the right shows you that anything above 50 means growth in unemployment plans. You're actually seeing an acceleration. So that's actually pretty good, considering that's the vast majority of the economy. That gives us some hope there that things will continue. And obviously, what it drives is personal consumption expenditures. We noted last month that February reflected the first downtick that we'd seen in a while, and then it recovered. Actually, it was January that saw the downtick, and February recovered. Also importantly, real disposable and personal income. So after you back out the impact of inflation, like the real income that people can spend is actually still growing. And that's good because that means that the consumer has more purchasing power. So a lot of what you're seeing right now, and forgive my voice, it's allergy season, is actually still pretty solid underlying fundamentals. If we look at the PMIs for services and manufacturing, they're pretty much recovered from the dip from a month ago. Excuse me. And you've seen the manufacturing sort of hung in there. One question we have to ask ourselves is if these tariffs are actually work the way they're intended to work, you actually might see kind of a manufacturing renaissance. We could actually see growth when we've seen essentially manufacturing shrinking here for honestly decades. But so it may not all be bad. Our best, our favorite real-time inflation gauge from Trueflation, I'm just showing here. Trueflation, shows that real-time inflation is still very much in check, very much below the 2% target from the Fed. So we think that if there's any real weakness in the economy, there's ample room for the Fed to cut. Now, the market is not pricing that in. The market has like 2 to 3 25 basis point cuts baked in. That seems reasonable. We don't think it's going higher for sure. It could very well be that we get additional weakness and they need to drop it even more and kind of implement what I've talked about as the Fed put to protect asset values. Time will tell. The one thing that we do know is that egg prices are down by like 50%. There was this well talked about kind of bird flu and then destruction of chicken stocks. And essentially that yielded very high prices that we now have fewer bird flu outbreaks, weaker demand at these higher prices, more imports from Brazil. And we now actually have egg inventories growing. So, as fast as those prices went up, they're now coming down. That's a good sign if you're into eggs like I am. portfolio strategy. This is really the meat of what we're doing with our strategies. When everything is so negative, right? I always use this analogy. When everybody's sitting on one side of a boat, it's time to start thinking about sitting on the other side. And that's where you can really get great risk-adjusted returns. So let's think about what can go right, as opposed we know what, everybody's assuming everything's going to go wrong. So let's just think about what can go right. Well, first of all, like I just said, the economic baseline is still quite positive. The labor market's fine. Core inflation's trending to target. That's your backdrop. Okay. We're not starting all of this from a, poor economic backdrop. It's a solid economic backdrop. Corporate earnings in this upcoming earnings season, they can be better than feared. I think the bar is really low. The bar was pretty high when we went to 4Q, and you saw a lot of companies not perform well on their earnings calls, largely because they had to get the 2025 earnings estimates in check. But I think the bar is actually pretty low. And so I'm actually anticipating that if in fact they can just hit their guidance, you could actually see rallies off of these earnings, which would be a good change. What if tariffs are not as bad as feared, right? What if we don't have 20% across the board, which is like what's essentially priced into the market right now? What if these negotiations that are likely to follow, reduce them? When you have basically the worst scenario priced in, which in some cases is, if you look at individual stocks, there's really nowhere to go but up. Less bad is good. And so we might get that sort of a situation with the tariffs. Hard to say, but we'll get more details, particularly this afternoon. Then we have to think about the tax cut bill. This will gain momentum in the market narrative. It's actually, as I've pointed out, I think at the beginning of the year, this is honestly the most important thing that we could be focused on. The tariffs, yeah, they're important, but if we don't extend these tax cuts, we're going to have a recession, and a pretty good one. So there's a lot that needs to get done on that bill. The Trump administration wants to not only extend the tax cuts, but maybe even increase tax cuts. That would be incredibly bullish for the market. But that's where people's focus will go after these tariffs. And then the other place they'll focus is deregulation. So now there is not usually a short-term impact from deregulation, but very often it will start to make, whether it's big infrastructure projects or whatever, on a company-by-company basis, allow investors to start to maybe increase their earnings estimates for 2026 and beyond. And that is really the next point, which is that when we get to like the middle of a year, investors are looking out to next year. We're not looking at this year really anymore. It's already priced in. We're looking at next year. And as I look at the estimates for a lot of the Mag 7 companies that have really gotten hit hard, I see opportunity for upside, honestly. So we'll see. But look, when the sentiment is this bad, it really only takes a few green shoots, to use a phrase from back in the global financial crisis days, a few green shoots to spark a recovery. So from what do we do? So prior de-risking activities that we took in portfolios has left us with a bunch of excess cash in many cases, and some conservative positions that will be sources of funds that we will use as things start to turn themselves around. We've already tried to take a very disciplined approach in buying stocks that have terrible sentiment, but great fundamentals. So we've begun nibbling at some beaten up tech names, some AI names. We, as I mentioned a month ago, we think some of the Doge-related weakness, particularly in the defense names, is what I'll call attackable. So we've made some investments there, and basically we're just getting ready to pounce as sentiment improves, because it can't stay this negative forever. We are obviously trying to avoid stocks that are directly or even indirectly exposed to tariffs. It's a little difficult to get zero exposure, but we've done a pretty good job, I think, of insulating portfolios from that. Obviously there's broader market implications that could impact the portfolio, like the market going up or down. But broadly speaking, we're not playing in Ford and GM. I will get to one other really interesting name here in a minute, though, that we did just recently enter. Um, we're not chasing China or Europe. I know they've been great performers this year. We don't buy this argument that's being sent around that this is the end of US exceptionalism. I just think there's just a massive overreaction of what's really going on. The reality is that Europe is still a mess. It's an economic mess. And although it's pretty cheap. And so we are spending some time looking at opportunities, particularly if local governments are increasing fiscal spending like Germany is doing. That could provide, an interesting investment opportunity. But broadly speaking, we don't want to own the whole thing. Um, Chinese growth, look, we think it's going to get impacted by tariffs, no doubt. And we think that really the bigger issue, the longer term issue, is that their banking system needs to be recapitalized. Right now they seem to be taking the same approach that Japan did. They've got boatloads of bad loans sitting on the books of their banks. Their banks are technically insolvent because they're not marking these books to market or marking these loan books to market. And so they're going to have to like slowly work this out. And if they try to do it organically, it could take decades, like it took the Japanese banks. So until they get much more serious about recapitalizing their banking system, we really don't have much interest in the risk reward opportunity there. Like I mentioned before, we're looking for mismatched concerns. So what do I mean by that? If you fear that we're going into a recession, then why aren't cyclicals underperforming? Right? Doesn't make sense. So we're looking for those concerns. Either that means that we just don't get involved. If we take a negative view towards the economy, we won't get involved in those types of cyclicals, or maybe we disagree and we see that the actual concerns about AI are unfounded, and this is actually a really good buying opportunity. So we're looking for mismatched concerns. We are still still really, really like our positions in gold, MLPs, mortgage REITs, and fixed income. These have been big outperformers. It's why I think all of our strategies are beating the S&P, and they've been great hedges. We've talked a bit in the past about fixed income and why we've stayed shorter duration. That's where the value is. But what we're trying to do is we're starting to think about adding duration to the fixed income portfolio. That would actually serve as a tremendous hedge if the economy really takes a downturn. Those things have the most juice. So we're spending some time on that. Don't forget the Fed put, right? The Fed can act, and they can act aggressively if there's a big problem. So we're not super worried that, whatever the tariffs do, first of all, the economic impact is going to take a little bit of time to work through. And if the data comes in weak, the Fed will cut. And that actually provides support, not only for the market, but also for the economy. And then, as I said, next up is the Trump agenda is the tax cuts and deregulation. So, while there's not a really, really great way to play that, we do have a number of names that are exposed to these issues, and I think that it's something that we're taking a closer look at if we want more exposure. But certainly, like for example, deregulating LNG will make it easier for one of our positions to build more of their plants and faster. So there's potentially some positive outcomes there. Real quickly, I'm going to run through just kind of our four of our strategies. In our global vigilance conservative strategy, really not a whole lot of changes. I mean, this strategy has really benefited from its fixed income exposure and its commodity exposure. The equities haven't done too terribly either, but it's just that's kind of the conservative strategies are generally speaking doing quite well in this type of a market. Our moderate strategy, which our flagship global vigilance, is still roughly around 60% equities. Still have about a 10% position in commodities. We've got a little bit extra cash that we're waiting to deploy, as I mentioned earlier. And it's actually really outperformed the market. And one of the reasons is that we've barbelled the equity risk between growth and value. And so while growth is basically taking it on the chin, value's actually done really well, really, really well. So, and then when you combine that with our commodities like gold that has done incredibly well and fixed income, it's, the whole blend of it is actually made for a pretty effective strategy in this kind of environment. One of the things that I'm going to do here that I rarely do is kind of lift up the covers a little bit and show you what our 10 biggest winners and our 10 biggest losers were over the last 12 months. Now, one of the things you're going to notice, and this is also one of the ways that we can show you how different we are from the typical equity guy or, fixed income guy. But these are all stocks, of course. Those have outperformed in the last 12 months. But on this list, you got gold miners. You've got 1, 2, 3 MLPs. You've got a Japanese technology stock. You've got an Indian bank. You've got a mortgage REIT. Okay, these are not normally found in a lot of investor portfolios. So the contents of what we are putting in our portfolio are oftentimes very different than what you would find, in a typical equity portfolio. And I think that's a major reason why we outperform. Those guys actually created about 133% of the total profit. The 10 biggest losers, you'll see, a lot of these are actually names that we actually love. They just happen to go through a bit of a pullback recently. A lot of them are tech names like Microsoft and Micron. There are, folks like Eaton that actually, a very important part of their business is used in their products are used in building out these AI data centers, which is still happening. So these are not like crazy risky names, but they just didn't perform well. But the collection of them only lost 40% of essentially the losses equated to roughly 40% drag on the total P&L. And so that's obviously way different than the 133% gain on the biggest winners. Now, what that means is we have a really high slugging ratio. So to use a baseball term, in slugging, right? That's like when you hit home runs, you get more bases than hitting singles. So what we're doing here is and a lot of this comes from not just picking correctly, but also sizing these names correctly. So when you're making a lot more money, as we are on our 10 winners versus our 10 losers, it means we're doing a really good job of sizing our names and having the conviction when we believe we're right to put our money behind it. So this is a really important slide I'll bring up. 2 more slides, and then I'll take your questions. Tilt. Okay, this is our aggressive version of global vigilance. It's 73% equities, 17% commodities, although a bunch of those are individual stocks. So basically, it's running at with 90% risk and 10% fixed income or cash. One of the stocks we recently bought is Tesla. Now, this is going back to my original point about not letting politics, cloud your vision. If you can do that, you can find extraordinary buys. So Tesla, for example, we bought it around $240 when basically when Tesla dealerships were getting lit on fire and swastikas were being put on Cybertrucks, maximum like extreme negative sentiment is always the best time to buy. And so we bought a little for this particular portfolio. It's only in this one. So we don't care we don't care about Elon Musk. We don't care about, we don't have a view. And so it's really important. If you can just strip away those emotions, you can find extraordinary buys. And so, we feel pretty confident about that one going forward. And then finally, I don't know, many of you may not know about this product, but Strategic Income was a product that we built a number of years ago to help particularly conservative investors and retirees, people that needed income in a zero interest rate world. That's effectively what we did. And so we built this portfolio that has like 30% equities and 70% fixed income. But a lot of these equities are very high dividend yielding. We have some preferreds in there. You can sort of, see in the infographic kind of all the different stuff that we have. And it's done terrific. Like this year, it's up, nearly 5% on a gross basis. And we sort of benchmark it against the high yield index. And so we've really kind of smoked that for the last, year or so. So we really love this product. It's been a really high performer in this environment. So let me stop there, Keith, and let's take some questions.
Awesome. And we actually have a couple, so good.
Great.
First one says that is khaki free and clear of the Abu Ghraib lawsuits?
Yes, is the answer. I mean, I asked them that question 2 weeks ago, and they believe they are.
Okay, super duper. Easy peasy. The next one says, what would be the first signs of the Trump tariffs working? Would we have layoffs first and then an increased employment in manufacturing? Obviously, you can't just flip a switch to turn on US manufacturing. So how long until we see signs of it working?
That's a great question. So let's take auto, for example. Um, so no one other than GM, no car maker other than GM has excess capacity. And I'm going to put Tesla aside for a second, but no one has excess capacity they can just essentially flip on to get more US content or more US production. GM does have some, but again, it's not like a light switch. But everybody else would have to build a factory. And if you talk to anybody, it'd take you 3.5 years. So, this whole notion of trying to move production here is not going to happen tomorrow. It's going to take many years. Yes, there might be easier permitting processes and whatnot, and you might be able to speed it up, a bit. But the reality is, you can't just build a factory like overnight. It's going to take time. So to the extent that the goal is to increase U.S. employment in manufacturing facilities, it's going to take a while before we see that. Um, Now, if the goal is just to merely like put our tariffs more in line with the tariffs that our goods are already getting overseas. Like, you know, for example, I think Denmark has either like a 25 or 50% tariff on US, like on Cadillacs. Should we, I mean, now I don't think they make any cars, but like, do you put a commensurate tariff on them? Um, you know, you could actually probably demonstrate some level of success, on that grounds. But honestly, like that's the trickiest thing about these tariffs is that it's not really clear what the goals are. Because one of the big risks, as I mentioned earlier, is, if you wipe out all of, like for example, let's say you're Volvo, they don't make anything here at all. So all Volvos, if they don't want to have any sort of impact to their gross margin, are going to have to raise their MSRPs by 25%, plain and simple. So what they might say is, well, it makes no sense for us to be here. If you're Mercedes-Benz, you might, and they have factories here, but basically they might say, you know what, it makes absolutely no sense to make C-Class anymore. We're going to only make S-Class because those consumers are, price insensitive. And so if you put that framework around like literally every product that we import, you're going to get very different answers depending on, the substitutability of that product and what part of the market is buying it. So like things that are, things that go to more budget conscious consumers, they may not be sold here anymore, and they may not be sold. Maybe they decide at that point that that particular product should be made in the United States. Maybe, and this I think is probably a more likely outcome is that the USMCA, which is, was Trump's renegotiated NAFTA from, 6 years ago or whatever. It could very well be that we fall back to that. So we fall back to, okay, well, it's okay if you produce it in Mexico. We won't tariff that or tariff it as much. So it is honestly very difficult to know what is the actual grounds. I mean, remember, the very first tariffs that were put on, the grounds were fentanyl and closing the border, right? So, what are we really trying to do? Now, I don't for 1 minute believe like Navarro, one of the advisors, when he says we can we can make $600 billion a year in tariffs. There's no way. Like that's not going to happen. But who knows? So yeah, it's a big, obviously I don't have the answers. It's something that we're going to do the work on when we get it. I mean, we will do the work and we will adjust portfolios as needed. But right now, I feel like we're pretty well insulated. So I don't know. We'll see how it goes, kind of thing.
It's awesome. And there's so much. I don't think anybody can accuse us of not doing our research as evidenced by this whole presentation. So it's
Right.
fantastic.
Yeah, look, I mean, I think importantly, just, before we move on to the next, this is why we're tactical, right? This is literally what we do is we digest information and then we make changes. And, so if you're invested in some other like strategy, it's, I always think of them as like fire and forget, like just they don't make changes to their strategy. And we really do. When we sit down and, we are constantly in dialogue about names, but we sit down at our Monday morning investments, committee meeting. The first question is, are we going to take more or less risk this week? And so this all plays into that. So, we this is, really this is actually this kind of uncertainty really does play well into our strategy.
That's great. I do not see any more questions. So with that, we would just like to again say thank you to everyone for taking time out of your day. Please feel free to reach out to us if we can provide anything for you. We'll be sure to send out the slides and the replay of this video once it's been through compliance. But if you need anything, again, feel free to reach out to us. Jim, thank you, and we'll see everybody next month, hopefully.
Great. Thank you.
Thanks.